The opinion expressed on this program, Money and Business, are those of the host and his guests, are not necessarily reflect the opinion of Radio Shalom. Please read the prospectus before investing in mutual funds and consult with your financial advisor.
Live from the studios of Radio Shalom, 1650 AM in Montreal, Canada, the city of Joie de Vivre, the world capital of culinary variety, and the home of the Montreal Canadiens. This is the Money and Business Show with your host, Samuel Izurzer, consultant with TE Mirador, a national wealth management company answering to all your financial planning needs since 1972, known as TE Wealth in the rest of the country and headquartered in Toronto. Every week, Samuel and his guests discuss money, investments, financial services, and the world economy. Over the next hour, you can have your questions about business and personal finances answered. So call 514-738-4100 extension 200 to speak with Samuel and his guests. And now, here is the host of the Money and Business Show, Samuel Izurzer.
Money, and exchange-traded funds. Have you heard about the ETFs, but aren't really sure what they are? Then you can hear today's show where we are going to learn some of the basics about ETFs and how they can benefit your portfolio, specifically exchange-traded funds in the healthcare and biotechnology. Exchange-traded funds are an upcoming investment vehicle because of their advantages over other investments, such as mutual funds. They have a lower cost structure, are easy to trade, and have a lesser impact on your tax bill. The children of the baby boomers were born between 1976 and 1994, so-called millennial. There are 76 million of them, and the oldest turned 35 in 2011. We will now add 76 million people to the investor demographics over the next 18 years. Where the baby boomers had mutual funds, the millennials have exchange-traded funds. ETFs, what they're called, their assets have grown from $50 billion in 2005 to $1.2 trillion today, and will grow to $5 trillion by 2020. So, if you're intrigued, stay tuned. We have live from Florida is Mr. Jeffrey Feldman, a Wall Street veteran for 42 years, founder and chief strategist for the X-Shares Group, an ETF company that was sold to Deutsche Bank in 2010. He also has been teaching economics nearly all this time as well. He will discuss today investment opportunities in healthcare and medicine using ETFs. Why healthcare ETFs, or specifically biotechnology exchange-traded fund, is the best way to profit as the baby boomers retire and are these exchange-traded funds. Retirement vehicles for seniors, or so are they more appropriate for young investors? My name is Samuel Izurzer for the Money and Business Show, Radio Shalom, CJRS 1650 AM in Montreal, the financial capital, the city of Joie de Vivre. I am a consultant for TE Mirador, a financial planner company. And if you have any questions on today's show, please give us a call, 514-738-4100, extension 200. Or if you want to email me, some people, they'd rather email me for some reason. It's Money and Business Show. I repeat, Money and Business Show at gmail.com. Today, so I'm going to introduce our guest, because basically what I want to do is, let's talk about a little bit more about the exchange-traded funds. ETFs are growing in size more than mutual funds. And today we have Jeffrey Feldman, a 42-year-old veteran of Wall Street, started his career at Goldman Sachs in 1970. Most recently, he was, he's a founder and chief strategist for the X-Share Group, an ETF company that was sold to Deutsche Bank in 2010. The X-Shares created ETFs in the healthcare and biosciences sector and partnered with TD Ameritrade on a series of target dates, the ETFs. So Jeff has taught courses in finance, economics, and various universities and community college in New Jersey. He has been a popular speaker at the professional and investor conference, including the Money Show, the Milken Institute, and the American Association of Individual Investors. Also, Jeff, along with the co-author Andrew Hyman, wrote a book called The Three Path to Profitable Investing, using ETF in healthcare, infrastructure, and environment, and to grow your business or to grow your assets, and that was written around May 2010. Jeff has an MBA in finance from St. John's University and a BA in economics. and Mathematics from Queens College. So how are you, Jeff?
Fine, thank you.
Good. Thank you for taking some time to speak with us on Radio Shalom on the Money and Business Show.
Glad to be with you.
Good, good. I know you're on vacation now. Is that right? I mean, you went from New Jersey to Florida, right?
Yes, I did.
By car? So,
yeah, it's a trek we make every year. We try to get away from the cold weather, and I'm happy to report it's 80 degrees and sunny here.
And you just made it on time for our show, right?
Apparently I'm here, yes.
Good, great. But you're not too tired, right? You're okay?
No, fine.
Good, excellent, good. So, Jeff, along with co-author Andrew Hyman, you wrote a book, The Three Paths to Profitable Investing, using ETF in healthcare, infrastructure, environment. What made you write it?
Well, I've been watching over the last several years as investors have been frustrated with the poor returns in the market and have started to seek out alternative investments in things like commodities and precious metals and in energy. And the fact of the matter is that those investments can't possibly work long term unless we have a vibrant economy. And we can't have a vibrant economy unless we invest in the industries where we're suffering right now. We're energy dependent in this country. We need to get away from that. We need to move to clean energy. Our infrastructure is falling apart. And healthcare is completely out of control in terms of its costs, just as we have a baby boom generation of close to 80 million people reaching their senior years. So owning assets that don't generate sustainable business, that don't generate jobs, and that don't solve the economy's problems ultimately can't make any sense. Ultimately, if we don't have a vibrant, growing economy, then what's the point of owning gold? Or what's the point of owning oil? If there's no economy, nobody's going to use the oil. So I think we lost our way a little bit. And having been on Wall Street for 42 years, I've seen this cycle before. In the late 70s, nobody wanted to buy equities either. We felt there was nothing to buy. We felt inflation was going to be endemic. And we felt that there'd never be a bull market again. And, of course, we were completely wrong. And I believe that the ingredients of the next bull market are well in place today. And so I wanted to put it down in writing and explain to people why I think that the United States is the best place to invest for the next 20 years, that in fact through the industry that we currently have and the technology we currently have, we can solve all of our problems. And so, I also believe that exchange-traded funds, which are mutual funds that trade on the stock market, so they're like a stock, except they are a stock that owns baskets of other stocks, are a great way for investors to build a portfolio in these important sectors.
Jeff, I agree with you. It looks like in the States, for the next 10 to 15 years, probably be the greatest place to invest. But over the long term, earning growth drives the stock market forward, right? In 2011, earning growth was about likely to be in excess of 13%, well ahead of, I would say, approximately about 7% on the long-term average. Despite these earning performances, the S&P 500 index was virtually unchanged, for last year, 2011. There was a fear of double-dip recession in the United States, and uncertainty surrounding the outcome of the European debt crisis led to the very volatile trading. Jeff, my question to you is, what is your outlook for the market in 2012, and do you see a similarity of the 1970s when investors were buying hard assets? You were mentioning oil and precious metals. Do you see any similarities the 1970s and today?
Very strong similarities.
Okay.
Bernanke, the head chairman of the Fed, has said that he's going to keep interest rates at zero until 2014. That is a kind of a floor under risk assets, because it's worth taking some risk in order to get some return, since you're not going to get a return from riskless assets. The baby boom generation, which is currently 47 to 65 years of age, is running out of time. In the United States, most baby boomers do not have enough money to retire. If they take whatever nest egg they have now and invest it in riskless assets at a zero return, they're still not going to have enough money to retire. Now, whether they should leave the money in riskless assets or not is an individual decision. But by and large, eventually people start to say, you know what, I've got to take a reasonable chance. And the great thing about ETFs, exchange-traded funds, is they give you exposure to innovation with mitigation of risk. You don't have to invest in one company, and you don't have to take single stock risk. You can invest in a basket. And so in what happens is that as a new generation emerges, that is the children of the baby boomers who are now turning 35, the oldest of them are turning 35, they start to become equity investors. Throughout the history of the United States, 70% of equities have been owned by people the age 35 to 55. You go back to 1981, that's when the oldest boomers turned 35. And over the next 18 years, close to 80 million people turned 35. And oh, by the way, we had a bull market during those 18 years. Then starting in 2000, the elder boomers started to leave the demographic, and we didn't have enough people behind them to replace them. But fortunately, they had children, about 76 million people, and they're now entering that demographic. When the boomers turned 35 in 81, they came to the market for the first time, and they found mutual funds. And they had a more positive attitude than their parents who had lived through World War II and the Depression. They had they were getting good jobs. They had a happy outlook about the future, and they were willing to take some risk, and it worked out very well for them. Now, as this next generation turns 35, they're confronted with a market that just like in 1981, looks very sour. But if you look a little bit under the surface, you start to see some great things happening in technology. It was announced that Facebook is going public, a company that likely will be worth $100 billion. Mark Andreessen, one of the great venture capital investors, announced that he's raised $1.5 billion to invest in the technology cascade that's going to come out of Facebook. And there are great things happening in healthcare as well. So as this generation with a brighter outlook, just like their parents 30 years ago, comes to the investing arena, they're going to find opportunities, they're going to be optimistic about the future, and they're going to start to invest in these companies. Now, back in the 80s, if you look at the statistics, the older investors continued to try to invest in the old economy. The old economy was a manufacturing economy. We now will likely try to invest in the information age economy because that's what's driven our prosperity over the last 20 years. But in fact, it's going to be companies that are involved in infrastructure, in healthcare, and in clean technologies that are going to drive our future. There are probably more jobs in those industries that have not yet been created than we could possibly fill over the next 20 years. So I believe we're right at the cusp of a prosperity now. And I think if you do a little homework, you can see very strong evidence that some of these companies are starting to emerge.
I guess somebody's going to have to talk to Warren Buffett, right? Because he doesn't understand. I guess somebody's going to have to talk to Warren Buffett because he doesn't understand the technology. He doesn't understand the technology.
Warren Buffett's an old guy who's had a great track record. If you've done very well the way he has done, why would you change? But the Warren Buffett of the next generation is going to be investing in the technologies that are going to underpin a vibrant economy. That's what Warren Buffett did.
Good. Jeff, just stay on the line. We're going to be taking a break. We're live from Florida. Is Jeff Fettelman, a Wall Street veteran for 42 years, founder and chief strategist of the X-Share Group. My name is Samuel E. Zerzer for the Money and Business Show on Radio Shalom, CJRS 1650 AM in Montreal. We'll be right back in 2 minutes.